Okay, so we are doing the September-December 2025 attempt past paper now. And question number one, we are going to start. The following exhibits available on the left-hand side provide information relevant to the question. Let's start. Drimpton Company is a large listed company based in the country of CompTIA currency dollar. So Drimpton is a large company based in CompTIA, the currency is dollar. It manufactures air conditioning units for homes and commercial buildings. It is regarded as the market leader as a result of its investment in the continual development of its products. So Drimpton is based in CompTIA, currency is dollar, manufactures air conditioning units for homes and commercial buildings, regarded as a market leader as a result of continual developments. Drimpton has expanded its sales to foreign countries over time. Recently, it has started selling to the country of Adricer and the countries surrounding it, which are located in different continents to Drimpton. So it has started selling to Adricer, countries surrounding it, and they're located in a different continent. Adricer and the surrounding countries have recently established a single market, the Central Trade Area, with the same regulations affecting how businesses operate. They have also entered monetary union and share a common currency, the peso. CompTIA is not a member of the CTA. Now, Drimpton is based in CompTIA, right? Currency is dollar. It manufactures air conditioning units. Drimpton, which is based in CompTIA, has expanded its sales and now entering Adressar and countries surrounding it. They're in a different continent. They all have established a CTA with same regulations affecting how business operate. They've entered monetary union. It's just like European Union. They share a same currency, peso. CompTIA, this country, is not a member of CTA. Okay, you are a country CompTIA. Drimpton operates in CompTIA. CompTIA is not a member of CTA. Drimpton is expanding into Adricer and surrounding countries. They have made a CTA, but CompTIA is not a part of that CTA. There has been increased demand for air conditioning units in the CTA due to higher summer temperatures. However, number of companies selling air conditioning units in these countries has been increasing. Many companies based in CTA have focused on selling air conditioning units to homes and are competing on price. These units are smaller, therefore better suited to homes than the units which Drimpton currently manufactures. Drimpton is proposing to establish a subsidiary in Adricer which would focus on manufacturing smaller air conditioning units for sale to homes in CTA. Labor costs for the subsidiary in the CTA are forecast to be lower than they would be with their current units for manufactured in CompTIA. Simple, classic case of overseas investment. That Drimpton is based in CompTIA, currency is dollar. It manufactures air conditioning units for homes and commercial buildings, market leader. Drimpton is expanding into foreign countries and now it's entering Adressar. Adressar is in a different continent. These countries have established a CTA, same regulations, one union, one currency, peso. And CTA has an increasing demand of air conditioning units. Okay. And Drimpton wants to establish a subsidiary in Adressar. Adressar is a part of CTA. CTA CompTIA is not. CompTIA country is not. The currency of the Adressar will be peso. Okay. When you establish a subsidiary there, so labor costs will be lower than they would be if air conditioning units were manufactured in CompTIA. So CompTIA country has a high labor cost, but if you establish a subsidiary in Adressar, the currency peso, it's a part of CTA, the labor cost will be lower. Financial details. Expected sales of the air conditioning units are as follows. Expected sales are 80, 110, 150, 160 for year life. Contribution in year one before deducting the cost of components imported from Drimpton and CompTIA will be 200 per unit, increasing in each of years 2 and 4 by the annual rate of inflation and Adressar. So contribution is given, no selling price, no variable cost is given, directly contribution is given. Therefore, in investment appraisal, we cannot write revenue, variable cost. We will directly start from contribution because contribution is given. 200 per unit increasing by the annual rate of inflation and Adressar, but this contribution is before deducting the cost of components imported from Drimpton. So this contribution is before deducting the cost of components imported from Drimpton. Obviously, Drimpton is in CompTIA. It's establishing a subsidiary. So a subsidiary has to import some parts. There will be an import cost as well, but this import cost is not deducted from this contribution. Subsidiary will then purchase some of the components from Drimpton and pay component cost of 12 per unit to Drimpton in year one. The component cost will increase each of years 2 to 4 by the annual rate of inflation in CompTIA. Drimpton will achieve a 60% pre-tax contribution in the sale of components to its subsidiary. Now, whenever there is import cost, subsidiary is importing from Drimpton. So for subsidiary, it's an import cost, right? But when you are giving it to the subsidiary, for subsidiary, it's an import cost. You will be earning contribution on that. So remember, after the remitted cash flows, we take after tax contribution on imports. So 60% contribution will be earned, but it's before tax. Okay. Inflation adjusted fixed cost will be incurred by the subsidiary. This fixed cost is inflation adjusted year 1, 2, 3, 4 in pesos. Drimpton will pay tax on profits in an annual rate of 20%. Addressor on its profits there. So Drimpton will pay tax on profits at an annual rate of 20% in addressor on its profits there. Obviously, Drimpton is setting a subsidiary in addressor, so it will pay 20% tax on addressor. Drimpton will pay tax on profits at an annual rate of 28% in CompTIA. So in addressor, where you are establishing subsidiary, the tax rates are 20%, but in CompTIA, it's 28%. A bilateral treaty exists between addressor and CompTIA, which permits offsets of oversight tax against any liability in CompTIA and overseas earnings. Tax in both countries is payable in the year in which the taxable liability arises, no delay. Tax credits for tax losses and given tax credits for tax losses are given at an annual rate of 20% at research, 28% in CompTIA, with the bilateral treaty also applying to tax credits. Okay. So tax credits are given for tax losses at an annual rate of 20% in addressor and 28% in CompTIA. So tax credits are being given for tax losses, and the losses are not being carried forward. But tax credit means benefit immediately is given. Losses are not being carried forward, but tax credits are given. Okay, usually in the questions you have seen that it says that losses can be carried forward, but there it's the case that tax credits for tax losses are given. So when profits, there is tax payment. In losses, there is tax credit, means an inflow, right? And when losses are being carried forward, you know how to do it. Okay. So tax credits are an annual rate of 20% at a 28% CompTIA bilateral treaty also applying on tax credits. There will be an immediate investment in the subsidiary of 30 million. Tax allowable depreciation is available on the initial investment 25% per year, reducing balance basis with the first allowance claimed in year 1. So TAD is available as well. First allowance claimed in year 1. It can be assumed that realizable value at the end of year 4 will be equal to the tax written down today, so that there will be no tax allowable depreciation in year 4. So you should assume that the realizable value of year 4, scrap value, will be equal to the tax written down value at the end of year 3. So whatever is the net book value at the end of year 3, same will be the scrap value. So whatever is the net book value, the same scrap value, no TAD will apply on depreciation. We will do the workings, then you will understand what does this point mean. Working capital each year 1440, 2080, 3000, 3390. Each year's working capital will be required at the start of their working capital will be released at the end of year 4. So this is the working capital requirements, including inflation. Predicted annual inflation rates are as follows. For addresser, the CTA 4566, for CompTIA 7654. Exchange rate is P6.2 equals to $1. I have told you one always in denominator. So it's P6.2 per $1. So dollar is in denominator. The home country is dollar. CompTIA is in denominator. So for CompTIA, it's an indirect quote. Subsidiary is likely to take some future sales of air conditioning units to homes away from Drimpton. So subsidiary will take some future sales away from Drimpton. Drimpton's loss of future sales can be assumed to be 11% of the subsidiary's forecast sales. So Drimpton's loss of future sales will be 11% of subsidiary's forecast sales. Unit sales price on these sales can be assumed to be 17 year 1, increasing each year by the rate of inflation in CompTIA. Pre-tax contribution margin on these sales can be assumed to be 40%. Now, what is this? You know that when you establish a subsidiary somewhere else, the countries will now purchase from the subsidiary rather than you. If there was no subsidiary, the countries will be purchasing from you directly. But if you establish a subsidiary, the countries will now purchase from the subsidiary. So there will be some lost contribution and opportunity cost, as I've taught you, lost contribution and redundancy. So lost contribution will be 11% of subsidiary sales, and selling price 70, increasing by CompTIA, and pre-tax contribution will be 40%, cost of capital is 10%. Okay, so it's a huge financial analysis case. Some ESG concerns. Third ed. The majority of Drimpton shares are held by institutional investors. There have recently been reports in CompTIA's media about institutional investors' varying attitudes towards companies fulfilling environmental, social, and governance criteria. Some institutional investors are still judging companies mainly on financial grounds, focusing on the aspects of ESG which most affect profit, for example, strong financial controls being part of governance. However, an increasing number of investors are going beyond financial consideration and assessing the sustainability of companies' business models in the context of their record in relation to ESG. These investors want companies to take sufficient actions to fulfill ESG criteria across their whole business and clearly disclose what they have been doing in their annual reports. In short, the majority of Drimpton shares are held by institutional investors. Recently, media reports say institutional investors are shifting attitudes and they want to invest in companies for focusing on environmental, social, and governance criteria. Many companies still are operating on financial grounds, but investors are increasingly focusing on ESG criteria. Drumpton's board is increasingly concerned about how its business will be judged using ESG criteria. It believes it has robust governance systems. It feels Drimpton treats its employees well in CompTIA, pays them relatively high wages. However, board is aware that labor costs of the proposed subsidiary in Adresser have been forecast on the basis of paying employees the average wage rate of Jordan's Adresser, the average wage in Adresser, and the rest of CT is lower than CompTIA. So Drimpton board is now worried that investors are now judging ESG criteria. Okay. It believes it has a good system of governance. It feels Drimpton treats its employees well and competent and pays them high wages, but board is just concerned that the labor rates in Adresser are low. So they will pay the labor in Adresser low. This might put a bad image in front of investors focusing on ESG, ethics, sustainability, environmental criteria, and governance criteria. Trumpton Post is also concerned about studies which highlight adverse environmental impacts of air conditioning units. One aspect is that emissions contribute significantly to global warming. Worldwide pressures over the last few years have resulted in governments introducing regulations requiring manufacturers of air conditioning units to restrict the level of emissions. There is also widespread concern about air conditioning units contributing to electricity usage in hotter countries. Countries in CT are all considered to be hotter countries. Research is currently being conducted to develop alternative methods of cooling. So now investors have started judging companies on ESG criteria, environmental, social governance issues. They want to invest in companies focusing on not only financials but ESG. Now, Drumpton's board is worried on two things. Number one, they think that they are paying good wages in CompTIA, but the wages rates in Advisor are low, CTA low. So how will investors react to this is something to be worried about. And secondly, they are concerned that many studies are now telling that air conditioning units create global warming. So there are pressure on air conditioning companies to reduce emissions. And there is also concern that air conditions take huge electricity. So they're concerned about this ESG issue. So anyways, there are three aspects. Number one, where you were investing in Advisor, which is a part of CTA. Number two, all the details of your investment, which we'll study again, and the ESG criteria. Okay. So after all this, we will move towards the requirement. Requirement A, explain the advantages from Drimpton of establishing a manufacturing subsidiary within the CTA. What will be the advantages to Drimpton of establishing a subsidiary within the CTA? Okay. If you go towards the CTA area, what will be the advantages of establishing subsidiary there? Okay, now you see that currently Drimpton is based in CompTIA, okay, and it wishes to establish a subsidiary in Advisor, which is a part of CTA, okay. So if establish a subsidiary in CTA, what will be the advantage of Drimpton? Now, firstly, if some countries in CTA want to buy air conditioning units from Drimpton, so Drimpton is in a different continent, okay, it takes a huge amount of time to deliver. If you establish a subsidiary in CTA, and CTA companies are operating as a one unit. If now they want air conditioning from Drimpton, it's in the same continent, so delivery times will be lower. Since it's the same continent, transportation costs will be lower. It's already written labor costs in CTA are quite less than CompTIA, so labor cost savings. So these are the three advantages which I will write first. Establishing a subsidiary in CTA will mean that all countries of CTA will now purchase from local subsidiary rather than from Drimpton in CompTIA. So delivery time will be much lower. Logistics cost will also fall, as now countries in CTA will be delivered goods from local subsidiary, leading to reduction in delivery costs. It's mentioned in the question that labor costs in CTA are lower than CompTIA, leading to cost savings. Okay. What else can be the benefits? It's just a thought process that if you establish a subsidiary in CTA, what will be the benefits? CTA will be following standard set of policies across all countries. So establishing a subsidiary there will mean a single set of policies have to be applied rather than different policies for different countries. CTA is a set of country. They have established a union, single currency. So that means they're following a single set of policy. You don't have to go and follow separate policies for taxation, legal requirements for different countries. Establishing in CTA means one policy, which will obviously beneficial. That one policy for all countries will save time and cost as well. Access to large number of countries with no barriers of moving goods between different countries can result in increase in sales. Okay. Now, obviously, you enter into CTA. All the countries are one union. So no barrier in moving goods between one country to other, like a Schengen zone, European Union zone. So this can increase sales because establishing a subsidiary in CTA means you're accessing many countries, not just one country. Okay. These are the benefits. Obviously, other points are also welcome, but you can write this. Okay, now the second part is worth a huge 35 marks. Prepare a report to board which estimates the NPV, 20 marks, good marks, recommends whether on financial grounds the investment should be undertaken, and discusses the issue this Drimpton company faces concerning the performance in relation to environmental, social, and governance criteria, recommends actions it can take to overcome these risks, 9 marks. Big requirement of 35 marks. Let's start with the report. You all know in report that it's true from date, subject, no post is mentioned, date, subject, 2 words, advisor project or investment advisor. Introduction, we all know this report, the known requirements, estimates NPV of Drimpton's investment in advisor. It then recommends on financial grounds whether project shall be undertaken and the assumptions made. Finally, it discusses issues faced by Drimpton in relation to ESG and recommends actions on how these issues can be overcome. Then headings of each. Recommendation on whether project shall be undertaken and assumptions. Issues in relation to ESG and actions. You all know any computational requirements will be dealt via appendix and any discussion requirements via the notes. So NPV is a computation requirement. So we will write Whatever the NPV is, you will write it. So let's move towards the spreadsheet and start finding the NPV. Okay, in international appraisal that we are operating in CompTIA and are planning to go towards a subsidiary in Adresser. So I've told you that the first step is the capital allowance schedule. So let's make a capital allowance schedule here. TAD capital allowance 25% reducing balance basis. Tax savings at whatever the tax rate is. We are establishing subsidiary in Adresser, right? So tax rate in Adresser is 20%. So it's a 4-year life, 25% reducing balance basis. So what was the amount? 30 million. So I will write it as 30,000. You need investment, then scrap value, then tax rate, capital allowance method, and same year or years. So we have everything here. Net book value will be 30,000 minus 7,500. Then net book value will be 30,000 minus 7,500 minus 5,625. Okay. Last year working is a bit different as I've taught you many times. Net book value at year 3 end. 30,000 minus all the depreciation charged before P5, P6. We will write whatever is the scrap value and gain loss on disposal. So what is talking about scrap value? TAD 25% reducing balance basis first allowance in year 1. It can be assumed that the scrap value at the end of year 4 will be equals to the tax written down value at the end of year 3. So scrap value at the end of year 4 is equal to the net book value at the end year 3. So what is the net book value at the end of year 3? This is the net book value at the end of year 3. Assume that scrap value is also the same. Will there be any gain or loss on disposal? No. Had it been net back value 12656, scrap value 12,000, there will be a loss. We put this loss here and take tax savings, but there will be no gain loss, so no. And that's why it's written. We don't follow their approach. Our approach is a bit different. That's why it's written here that there will be no TAD in year four. Okay, no TAD in year four. Obviously, when the scrap value at the end of year four is same as net book value at the end of year three, when net book value and scrap are same, no gain loss disposal, so no figure here. And the tax saving will be at 20%, so just the P4 steric 0.2, and we drag it. Okay, so we have made the capital launch schedule. The first thing. And after this, we needed the, what do you call, exchange rates. This is what I've taught you, that clear these things. So if we talk about exchange rates, you are given the spot rate 6.2 per dollar. So dollar is in denominator, so it's P per dollar. Because one is always in denominator. So it's 6.2 P per dollar, P so numerator, dollar denominator. And you are given, I think, inflation rates of both. 4% peso addresser and 7% dollar COMDIA. So 6.2, if you apply the parity theory into 1 plus 4% over 1 plus 7%. Okay. Then 1.05, 1.06, 1 plus 5% over 1 plus 6% because dollar is in denominator. Then 6% in numerator, P is in numerator, and 5% denominator. 6564. So we have got the capital and schedule as well as the exchange rates, which I told you that first two steps are usually these in international appraisal. Now, once you are done with these two, we should start making the NPV thing. Okay. And for NPV thing, it's 0, 1, 2, 3, and 4. Okay, so it's 0, 1, 2, 3, 4. You all know investment starts. Now, since you are based in Drimpton, based in what CompTIA, and you are investing in Advisor. The currency of Advisor is peso. So if you're in CompTIA dollar and you're investing in Advisor peso, all inflows outflows will be in pesos. Okay, so let's start. Investment 30 million pesos. I'll be working in thousands. Okay, revenue variable cost not given. So revenues less variable cost, directly contribution is given. Contribution in year one will be 200 per unit. So contribution will be 200 per unit. And it's increasing in year 2 to 4 by the annual rate of inflation in addresser. So contribution is 200 per unit. It's increasing in year 2 to 4 by the annual rate of inflation in addresser. So rate of inflation in addresser is 4566. Okay. So we will start at contribution. 80 per unit. Pesos. Sorry, 200 per unit in pesos. To how many units? 80,000. So 80. 1600. Now it's 200 per unit in year one, 80,000 units, but will increase by 2 to 4 by the annual rate of inflation. So in year two, it's going to be increasing by the rate of inflation. 200 rate of inflation addresser, 5%. Increase by the rate of inflation, and the units are 110. Okay. 23100. Then it's 200 in year one, increasing by the rate of inflation in 2 to 4 by addresser. So it's 5% in year two. And now in year three, it's 6%. Remember, 200 was in year one. So increase by 5%, then 6%, 2 and 3. And then you multiply it with units. How many units are there? 150. Then 200, 5% year two, 6% year three, 6% year four. And how many units are there? 160. 37753. Okay, once you have the contribution, that means you have taken revenue and you have taken the variable cost as well. So after that, we have fixed cost. So what is the fixed cost here? Inflation adjusted 3200, 3360. Okay, so it's revenue less variable cost less fixed cost. Then there is import cost. in international appraisal. Then there is royalty with subsidiary have to pay. So I don't think so in this question there is royalty. So I will not write that. But import cost is there. That subsidiary will purchase some components from Drimpton, pay 12 per unit in year one, and will increase in 2 to 4 by the annual rate of inflation in CompTIA. So subsidiary will purchase some of the components 12 per unit, and it will increase by the annual rate of inflation in CompTIA. So CompTIA's rate of inflation is 7654. So import cost is basically it's 12 per unit, right? Year one, 80 units. Okay. Will increase by the rate of inflation in CompTIA. So from 2654, 110 units. Okay. Then 12 into 6% for 2, 5% for 3. Into how many units are there? 150. And then 6, 5, 4, 160 units. Now you need to recognize this thing that this import cost is in dollars. See, $12 per unit. 80 units, increasing my rate of inflation, CompTIA dollar into units. So this is in dollars. Everything here needs to be in pesos, right? So exchange rate already calculated. So import cost in peso will be, now pay attention. At the moment, we are where? In Advisor. We have invested in Advisor. So all inflows, outflows will be in pesos. So we are in Advisor at the moment. We are in Advisor at the moment, right? Because we have invested in Advisor. So all inflows, outflows will be in pesos. So we are in Advisor. All inflows, outflows in pesos. We're in Advisor. The exchange rate is peso per dollar, peso numerator. So at the moment, it's a direct quote, right? At the moment, it's a direct quote. So convert in peso by multiplying P18, P15. Okay, this is import cost in peso. negative P19. Okay, so we have got revenue, that's variable cost less fixed cost, contribution less fixed cost, import cost, no royalty. Okay, so we can end up here at taxable profit and tax and do the tax savings approach, or you can deduct TAD, then taxable profit, tax, add back TAD, add back working capital. You can do that approach. Both approaches are acceptable. I've told this multiple times. So if we do the TAD approach, we'll deduct tax allowable depreciation from here. Year one, it's negative 7,500. That's P4. So after deducting the revenue, variable cost, fixed cost, import cost, royalty, we get taxable profit. If we do the TAD approach, we deduct TAD as well. We end up at taxable profit. So it's minus, sorry, sum of B3 to B7, and you can drag it. You pay tax for an advisor, 20%. Okay, so this is profit, no tax. Here it's loss. It should have been carried forward in normal circumstances. Like what we used to do is that here no tax because of loss. And then 5762 gets offset by 485.1 so that the profits get reduced and tax get reduced and we pay 20%. This case applies when nothing is mentioned or it says losses are carried forward. Here the question is clearly saying that tax credits for losses are given at 20%. Okay, so tax credits are given for losses. If it's a benefit, okay, we pay tax. If it's a loss, we get a tax credit, no carried forward. Okay, so tax credit is 20%. So whatever is the loss, we will get a benefit at 20%. So 485.12. C8, 20%. Okay, and all others will pay tax. After tax, we add back TAD. $7,500, 5,625, 4,218.80. Now after that, there is scrap value. Remember, 12,656.25. Working capital investment and working capital recovery. Okay, no tax savings from capital allowances because we have done the TAD approach. You will get at net cash flows. So what is the working capital investment? Including inflation at the start of each year, for each year. So for year one will be in zero, negative 1,440. This is working capital for each year and will be required at the start of the year. So this is required at the start of year one. So we'll put it in zero. This is required at the start of year two. This is required at the start of year two. So end of year one, 2080. But you will put 2080 at the start of year one, but 1440 is already present. So you will just put 640. Then in year three, 3000 is required at the start of year three. So end of year two, this is required. Now 1440 was required at the start of year one. So you put it in zero. This was required at the start of year two. So end of year one, 2080 was required. 1440 already there. We put 640 more. This is required at the start of year three. So end of year two, 3000 is required. End of year two, 3000 is required. But we have already put 1440 and 640. We'll put 920. And this is required at the start of year four. Okay, so end of year three. This is required 3390. But you have already put 920, 640, 1440. So you'll put and just total whatever working capital is injected. 1440, 640, 920, 390. This will be recovered. No tax savings from capital allowances. Those dealing in tax savings from capital allowance approach would have not done this TAD thing. They would have just ignored that TAD, and in the last row, they would have added these savings. 1500, 112, 5843.75. No problem in that. So that's it. And we will move towards the net cash flow figure. So it's now the sum of B8 to B13. Now this net cash flows is in pesos, right? Since you were in CompTIA dollar and you invested in Advisor, so all inflows outflows in pesos, the investment, the contribution 80 per unit into units, and then inflation, then fixed cost in pesos, then import cost 12 per unit increasing by CompTIA into units. But this was in dollars, so we converted into peso. We are in Advisor at the moment, so peso numerator direct quote. Then after input cost, there is royalty, no royalty, then TAD deducted, so get taxable profit, paid tax, and there was no carried forward thing. There was credit given, so I took the credit and add back TAD, then working capital recovery, scrap value, no tax savings from capital allowances because I've done the TAD approach. You get net cash flows in pesos. Now, Drimpton is in CompTIA, home currency dollar. They invested in Advisor. All inflows out in pesos. So when they have earned in the end pesos, I told you they will not keep it there. They will remit it back to their home country because they will not keep pesos at the end of the year to the subsidiary. They will remit it back to the home country called remitted cash flows or NCFN dollar, whatever you want to say. Okay. Now, how do you get NCFN dollars? Now, where are you? Now I'm in Comptia. I'm in Drimtree, Comptia, sorry. Okay. When investing, I was in Advisor, but now at the time of remittance, I am in Comptia. So since I'm in Comptia now, I want to remit cash flows. My money's there. I invested in Advisor, all inflows, outflows in pesos there. But now I want to bring back money to my home country. So now I'm in Comptia. So now when I'm in Comptia, my currency is dollar. It's in denominator. It's in indirect quotes. Now I will divide, right? So it's B14 divided by 0. So spot rate was, I think, 6.2. Let me just confirm. 6.2. For year one, it's C14 divided by P14, P15. Then it's D14 divided by 2. Q15, E14 divided by R50, F14 divided by, okay, so these are the remitted cash flows. Okay, now once you get the remitted cash flows, I've taught you four things. Now, remember those four things which I've been taught to you after remitted cash flows. Additional tax, remember? After tax contribution on imports. Then after tax royalty income. There's no royalty, so won't write it. Redundancy and lost contribution to tax. You will end up getting final net cash flows in dollars. And then you will multiply it with the discount factor to get present value NPV, or you can use the NPV function. Okay. So last four things now: additional tax, after tax contribution and imports. Obviously, as a subsidiary, we imported parts from Drimpton, right? As a subsidiary, we imported parts from Drimpton. So for subsidiary, it was an import cost. But now for the parent, since we imported them parts, the subsidiary bore the cost. But for me, it's an income. So after tax contribution and imports. Similarly, if there is any redundancy and lost contribution after tax, you need to write that as well. There was something mentioned in the question regarding this as well. Had it been royalty fee, so subsidiary would have paid royalty fee to the parent. So for subsidiary, it was a cost. I would have recorded it negative like I did it in the class. But for parent, it's an income. So after tax, royalty income as well. Okay. So once these three, four things are over, then I think our good 20 marks requirement will be done. Okay, now about additional tax, you all know that we invested in Advisor. So the tax rate there was 20%. Now we remitted back money to our home country in dollars. Now in our country, the tax rate is 28%. So treaty exists, so we have to pay 8% more tax, not on this figure, but on figure of taxable profit. Okay, on profit, we have to pay 8% more tax. Okay, I will delete this now because I want everything to remain on one screen. Obviously, in exam, you can change the screen, go down, scroll down, and do the workings there. But I want to keep it on the same screen for you, therefore I'm deleting this. Okay, so for additional tax, working two. Now, how will we work around the additional tax? Okay, it's simple. So additional tax is basically taxable profits. Additional tax 8% is not on this remitted figure. Always remember, people make this mistake. I've taught you multiple times. Additional tax is basically on profits. So profits were C8. On this, you pay 20% advisor, but now you are in your home country, so you need to pay 8% more tax. So it's basically P2, strike 8%, drag it. But remember, this taxable profit was in pesos, right? This was in pesos. So additional 8% has also come in pesos. Okay. Due to my deleting, I think the capital allowances figures have gone away. 7,500. I'm sorry for that. Okay, so coming back, so basically the taxable profits were 485 negative and 5762, 1353, 20327. These were in pesos. You won't pay additional tax of 8% on these figures. On these profits, you paid 20%, and on these profits, you will pay 8%. Okay, so these were the taxable profits. This was a loss, so you will get tax credit of 8%. So it should be positive. This one should be positive. Okay, and all these should be the additional tax. Right? But this additional 8% is in pesos because this taxable profit was in pesos. We paid 20% there in pesos. But now the additional 8% is also coming in pesos. Okay. Uh, will this policy apply on tax credits as well? It's clearly mentioned that tax credits for losses are given at an amount of 20% in advice to 28% CompTIA with bilateral treaty also applying on tax credits. So treaty also applies on tax credits, right? So you paid 20% there and got 20% credit there. So now you will pay 8% more here and 8% credit. Okay, but that's in pesos. So additional tax, dollars, just apply the exchange rate. How do you apply the exchange rate? You are in CompTIA at the moment. Your currency is dollar because you have remitted money, you're in dollars. Dollar is in denominator, it's an indirect quote, so just divide P4. So additional tax in pesos has to be converted by applying the exchange rate. It's P3 divided by the exchange rate, so it's in P15 and you drag it. So additional tax is gonna be here one P4 drag. Then after tax contribution and imports, this is the second last thing. It's two working three here. Okay, so after tax contribution and imports, or you can simply write working three here, working two here, working one here. So contribution on imports. Okay, so it's 12 per unit, increasing by 224 by the annual rate of inflation. So it's 12 per unit, increasing by 6, 5, and 4, multiplied by the units. This is the sale you made. Okay, this is the sale you made, which was a cost for the subsidiary. Okay, you sold each unit for 12, which increased by the rate of inflation multiplied by the units. So you sold items worth 5785, 8352, 12073, 13650, right? They This was their import cost. You sold them 12 per unit into units into the inflation rate. So they purchased goods from you worth 5785 in year one, 8352. That means you sold goods worth this. Contribution. How much contribution you're earning on this? 60%. So P7. Okay. After tax contribution. So you will pay 28% tax on it, right? Because now you are in CompTIA. So you earn 60% contribution on the items imported. You have to pay 28% tax on that. So 3471 steric 1 minus 0.28. This is the after tax. Okay. And you can simply convert this peso value. You are in Drimpton at the moment, CompTIA at the moment, sorry. So dollar is the rate divided. So this is the after tax contribution on imports. Whatever the goods sold, got contribution 60%, then contribution was an after tax by paying 28%. So this is in pesos. For dollars, you took the exchange rate. Okay. Now, after tax contribution in imports is P10. Okay. You could have also done it this way, that I took the peso value whatever I sold. They purchased from me, for them import cost, for me, it's a revenue. I took 60% contribution on that in pesos, and after tax contribution, applying 28% in pesos, and then in dollars. You could have done it directly as well, that this was the dollar value of goods sold, right? Just trying to show you that this way, Calvin, and this was the dollar value, 960. Like you imported goods, the cost was $12 per unit into 80 units. 960 was in dollars. So contribution was 60% on that. So you directly got in dollars. For after tax, 415. See, 414, 415. You could have directly done it in dollars as well. So regardless of you take the pesos values, then contribution 60%, then after tax, and then converting into dollars, you could have directly taken in dollars as well. That 12 per unit is the amount of goods I'm exporting. Import cost is subsidiary will uh, pay component $12 per unit Drimpton. So they're paying us $12 per unit. We are earning 60% on that. So 60% of that 12. And after tax, you directly get the dollar value. Same for 15, and you're also getting it indirectly as well. Finally, redundancy and loss contribution after tax. So the redundancy and loss contribution after tax is the last thing. Now, what is the redundancy and loss contribution issue here? The subsidiary is likely to take some future sales of air conditioning units to homes away from Drimpton. Drimpton's loss of future sales can be assumed to be 11% of subsidiary's forecast sales. This is the subsidiary's forecast sales. Okay. And you can assume that 11% you will be losing loss contribution. Okay. Contribution is 40%. You just need to make it after tax. Okay. So let's do this. Lost contribution. First, I will write the units lost. You don't have to show it in the middle. You can easily continue scroll down, but I'm just trying to keep everything on the same screen. So units lost. Units lost, I think in leave it. So units lost in year 1, 2, 3, 4 are 11%. 80 units. Okay, these are the units lost in year 1. One ten, 150, 160. Okay, these are the units lost. These are the units lost. Now, so just for an idea, the units lost in year 1, 2, 3, 4 are 8.8, 12.1, 16.5, and 17.6 units lost. Okay. Obviously, if 11% units are being lost, you will lose the contribution as well. So these units lost, sales price 70 in year 1 and rate of revision CompTIA. So year 1 is 70 selling price, then 654. So price is 70 in year 1, increasing by 6, then 5, then 4. Okay. So this is the selling price and these are the units, right? Selling price and units. Contribution. Contribution is 40%. So either you can do that first, convert it into the total revenue, units into sales. These were the sales lost. That 8.8 units lost to 9. These are the revenue lost. And contribution 40%. So this is the contribution lost. Okay. And for after tax contribution, it's simply contribution lost. Okay. So it's H13, negative H13 because it's a loss. And you can drag it. So the redundancy and loss contribution after tax working. That first, I took how many units are lost. So it's 11% of the sales. So 11% of the sales units. Then selling price was 70, increasing by rate of inflation. I increased the selling price. I got the revenue lost. 40% was the contribution. This is contribution lost. And then after tax. Okay, so after all this working, you have got the net cash flows in dollars figures now. It's a sum of B15 to B19. Sorry, B18. And then we drag it. I think the discount rate in the question is 10%. Yes. So either you can apply the discount factor 10% to get present value NPV, or you can apply simply the NPV function. So NPV function is basically equals to NPV, bracket open the discount rate 10%, comma net cash flows from year 1 till year last. That is C19 to F19 plus net cash flows of year 0. That is B19. 3511 positive. This is the NPV. Obviously, a bit time consuming, but even though it's a bit time consuming, it's a good 20-mark question that we were in Drimpton CompTIA and we invested in a subsidiary in Adricer. So in pesos, all inflows, outflows in pesos, investment, then contribution 80 per unit, increasing by inflation into units, then fixed cost, then import cost. Obviously, it was 12 per unit they were selling to us. So for us, it's a cost 12 per unit, increasing by inflation into units, but that came in dollar. So I converted into peso by exchange rates, then TAD deducting, then taxable profit. You paid tax and there was loss, no carried forward, you got a tax credit. Then add back TAD, scrap value, working capital investment recovery, and working capital recovery, net cash flows pesos, remitted to our country. We are in CompTIA now, so now our home currency is dollar. So we divided it because it's an indirect quote. Net cash flows in dollars, additional tax 88% on taxable profit, and it was in pesos again, converted in dollars. After tax contribution in imports, whatever import was there, 12 per unit into units, the import cost. We earned 60% on that. We took 60% then after tax, okay, and lost contribution, whatever the units were, into selling price, into contribution, and then after tax, okay. It was a good 20-mark question, and I don't think so there is any discussion on this as well at the moment in this appendix. NPV, so we'll just write in the report that NPV is 3511 positive. Okay, so you can copy this and then we will work around towards the next parts. Okay, it was a very good and mark scoring question. So working for is basically here, right? And it's starting from the units loss. This 8.8, 12.1, this is the units loss, right? Okay, now we have done the part A, advantages of establishing subsidiary in CTA. So you know that if we establish a subsidiary in CTA, definitely the logistics cost will save, labor cost will be saving, better access to markets, no regulations. Okay. Then we have discussed this prepare a report to board which estimates NPVs and with this. 6 marks, very easy. Recommend on further financial grounds investment should be undertaken, and since NPV is positive, it should be undertaken. Discusses the assumptions made. I've taught you how to write assumptions. It's a very easy 6 marks question. So that means together with this 20 marks, the 6 marks requirement is very easy. So I will write this as well. It's a theoretical requirement, so would come in report. Since NPV is positive, project should be undertaken on financial grounds. However, following assumptions were made while calculating NPV. 1 mark for this, 4 or 5 assumptions would easily score 6 marks for you. Okay. If there are any assumptions, assume a cost of capital of 10%. Okay. Pre-tax contribution is assumed to be 40%. It assumed that the resale value, scrap value will be equal to net book value. Third assumption. Then tax rates are assumed constant. Then inflation rates are used to predict inflation exchange rates, whereas they may depend on interest rate parity. So very good question. Very mark scoring question as well. So let's start. It is assumed scrap value will equal the tax net book value or written down value. How is this based and why it will remain same is not mentioned. Okay. On the lost sales, the pre-tax contribution margin is assumed as 40%. Contribution margin is assumed as 40%, but no info is provided on how it was calculated. I would like to add one more point in cost of capital. Also, changes in economic conditions may result in change in cost of capital, which can affect NPV. These three, it is assumed, was given in the question. I will write to myself, it is assumed tax rates will remain constant throughout life, whereas the CTA may decide to change tax rates, which will affect NPV. The exchange rates calculated are based on purchasing power parity, that is inflation rates, whereas exchange rates can base on interest rates too. So I think 1 mark whether a project should be undertaken. Since NP is positive, it should be undertaken. And 5 assumptions are very much okay for 6 marks. So in my opinion, this was a very good mark scoring question that you got 20 marks approximately for this NPV. This 5 marks was also easy. Maybe student might keep an idea of 2-3 points. So 2-3 marks from here. 20 marks, very easy NPV, straight for a direct investment question that first had capital schedule, then exchange rates, then investment, then revenue, then variable cost contribution, then fixed cost, then import cost and royalty, then TAD, taxable profit, add back TAD after paying tax, working capital, scrap value, no tax savings, capital allowances because I've done the TAD approach. Otherwise, add tax savings from capital allowances. You get net cash flows in pesos. Want to bring you back to your home country. So exchange rate impact. Now there at that time you were in pesos, now you're in dollar. So indirect code divide. Remitted cash flows, then 4 additional transactions, additional tax of 8% on taxable profits in pesos converted into dollars. After tax contribution and imports, just check how much you are importing, what's the selling price, what contribution you're getting, contribution and imports, and after tax. Lost contribution, whatever is the revenue, what is the contribution, that will be lost, and after tax. You get net cash flows in dollar, apply the function, get the NPV. Okay, so the NPV is also done. And after the NPV, there was a requirement of whether it should be undertaken on financial grounds. I wrote this. And assumptions, so 5 assumptions, okay? You can write these 5 assumptions as well. So apart from this, I think spreadsheet area. You are done with the spreadsheet, the NPV part as well. Okay. And after the spreadsheet part, we were able to do that word part as well. Okay, so NPV is also there, and this void requirement is also there. You can note these parts, and then we can move towards the last part to wrap it up. Okay, now we have answered the part A, advantages of CTA, establishing a manufacturing subsidiary in CTA. Then we have done the report part, NPV, then recommend, and then assumption. So the last 9 marks part. Discuss the issues which Drimpton company faces concerning its performance in relation to ESG criteria. So you need to discuss the issues which Drimpton faces concerning its performance in relation to ESG criteria. The issues are already mentioned here, right? The issues are already mentioned here, so you need to discuss these issues. Like it says that discuss the issues which Drimpton faces concerning in relation to ESG. So what issues it's facing? It's mentioned in the question that increasing number of investors are going beyond financial considerations and focusing on those companies which have a good ESG record. Then labor cost in CompTIA are higher, and the wage rate in Edresser is lower than CompTIA, so it is concerned about that as well. And it's concerned about the environmental impact and global warming, electricity usage. So the issues are already given. So it's asking you to discuss these issues. That discuss the issues which Drimpton faces concerning ESG. So you need to discuss these issues and recommend actions Drimpton can take to overcome the issues. So you need to recommend some actions as well. So it's general discussion part. We will try to write as many points as here. So firstly, discuss the issues which Drimpton faces concerning its performance. I need this as well for the answer. Drimpton is facing a number of issues in relation to ESG criteria. Only few institutional investors are judging company on financial grounds, and majority are now focusing towards ESG. Okay. Investors want companies to take sufficient actions to fulfill ESG criteria and clearly disclose what they've been doing. Firstly, institutional investors are now shifting focus, and they prefer companies that are not only focusing on financial aspects, but they are fulfilling ESG criteria also. If institutional investors are not satisfied with what Drimpton is doing. They may decide to divest from the company or exit from the company, which can lead to lack of funds as well as fall in share price, right? Similarly, investors now also want companies to take actions and disclose in their annual reports. Another issue is that institutional investors want company to take actions to fulfill ESG and also disclose in their annual reports. This can increase costs for Drimpton or any company. Obviously, taking actions to fulfill environmental, social, ethical issues will increase costs for Drimpton and will increase compliance requirements also. You need to discuss issues that Drimpton is facing in relation to ESG. So, discuss issues Drimpton faces. So, one issue is that institutional investors can pull their shares. Another issue, they want reporting, so increasing compliance. They want investment and actions, increasing cost. What else the issues Drimpton is facing? Another issue. The governance, the G of ESG, the G governance is good, but it's a social issue that they will pay employees average wage rate of hairdresser, which is lower than CompTIA. So you can discuss this as well. Another issue which Drimpton will face is that although it has good governance systems, it will pay wages to labor in advisor according to wage rates of advisor, which are comparatively lower than CompTIA. This can create social issue that one company is paying employees higher rate in one country and lower rate in other country. It's a social issue. Okay. In the third paragraph, there is an environmental issue. You see, I am capturing everything from the question. It's just general discussion, nothing else. Another issue that there are studies highlighting adverse environmental impacts of air conditioning units, that their emissions contribute significantly to global warming. Pressure groups have resulted in regulations. Okay. And they're also contributing to higher electricity usage. Another issue, Drimpton is facing related to environment. Studies are saying that air conditioning emissions create global warming and governments are introducing regulations to restrict emissions. These regulations may result in high costs for the company and more regulatory requirements. Another environmental issue is that air conditioning units are resulting in high usage of electricity, and research is being done on alternative cooling methods. Any alternative methods can result in loss of sales of air conditioning, leading to business risk. Okay. So in these 9 marks, the first portion of this requirement was discuss the issues which Drimpton faces concerning ESG. So all the issues were mentioned in the question that institutional investors are focusing towards ESG. This is an issue which can result in more compliance, more cost for the company. Another issue that governance is good. Okay, G is good, but there is a social issue that you are paying higher wage rates in CompTIA, lower in advisor. Okay, and environmental issues has to be discussed that alternative cooling methods are being developed, which is obviously business risk for my company, and global warming. So more regulation. So these are the ESG issues. Now, recommend actions Drimpton can take to overcome these issues. So what you have written the issues. Now you just need to think and recommend some actions which Drimpton can take to overcome these issues. So there are mainly 4 issues discussed. First, the institutional investors are focusing, they're shifting their focus. And another issue that cost and compliance requirements will increase, and it is paying lower wages. Okay. And secondly, business risk. So what actions Drimpton can take to overcome these issues? In order to overcome these issues, Drimpton can take investors into confidence regarding ESG. A department that focuses on ESG can be established and given the task to ensure company not only focuses on financial aspects, but takes actions in respect to ESG. This will increase investors' confidence in the company. So for this issue, that institutional investors are shifting on those companies that are focusing on ESG. You can take investors into confidence. You can make a department as well. And that department's task will be to focus on ESG rather than just focusing on financial issue. Okay. Another issue which you mentioned above, because you need to recommend actions to overcome these issues. Another issue which you mentioned that investors want companies to disclose in their annual reports, increase compliance. Drimpton can disclose whatever actions it is taking with respect to ESG in its annual reports to increase compliance. What was the other issue? Investors wanted reporting in their annual reports. So to overcome this issue, you can increase your compliance, disclose everything which you are taking. Okay. Third issue, social issue, that it will pay wages to labor in a dresser according to a dresser wage rates, which are lower than CompTIA. Okay. As far as wage rate issue is concerned, Drimpton can pay workers in a dresser same rates as workers in CompTIA so that no social issue is created. Okay. Another issue which you discussed with respect to ESG was that a social issue can be created that you are paying lower wage rates to advisor workers, although they're according to advisor country, but it's your subsidiary. You are paying one subsidiary's workers higher wage rates, CompTIA, and one subsidiary lower wage rates. So social issue, you can make the same pay rates. Okay. Another issue which you discussed was related to environment. So recommend actions which you can take to overcome this issue. So the environmental issue, that governments are introducing regulations to restrict emissions. So to overcome this issue, company can start working on some technology which creates lower emissions. Like this issue is with respect to cars as well. So now companies are making electrical cars to reduce emissions. Similarly, that there is an environmental issue that air conditioning units are using high electricity. Alternative methods of cooling are being established, which can lead to business risks. So to overcome this issue, you can invest in technology and start making air conditioning units which consume low electricity, like inverters. Similarly, alternative cooling methods are being considered. So you can make a research department which focuses on alternative cooling methods with low electricity. So through these research and technological innovations, you can take action to overcome this environmental issue, right? As far as environmental issue, Drimpton can start working on air conditioning units with lower emissions. Investment in such project and a dedicated department can be set up that focuses on making air conditioning units with low emissions. Similarly, air conditioning units are consuming a lot of electricity. So, new technology units that consume low electricity, like inverters, can be made, and investment in such technology can be made. Alternative methods of cooling can also be researched on, right? So first it asked that discuss the issues which Drimpton faces. So all the issues were present that institutional investors were running. You were paying lower wage rates to sir, and you were having an environmental pressure that they produce global warming due to high emissions and they consume too much electricity. So I discussed all these issues, that these issues are going to impact companies, investors may run away, and social issue that one company is paying higher rate one place at lower rate other place, and environmental issue that global warming and stuff like that, and new technological methods and alternative methods of cooling are being researched, so this can lead to business risk. How you can overcome this issue as far as your institutional investor issue is concerned. To overcome this issue, we can take them into confidence, set up a department which focuses on ESG. As far as the reporting requirement is concerned, you can start disclosing in your annual reports what you are doing for the ESG. As far as the wages rate is concerned, you can match the wage rates. Okay. As far as high electricity use is concerned, you can start making air conditioning units offering consuming lower electricity like inverter. You can invest in technology of inverter. Similarly, if people are researching on alternative methods of cooling, you can again focus on alternative methods of cooling and start investing in that. Okay. Similarly, that issue that air conditioning units are producing high emissions, you can invest in such units which produce low emissions. Okay, so these actions can be taken to overcome these issues. But people ask me that if you will take all these actions that match the wage rates, invest in technology so that low electricity units, air conditioning units are being made, you can set up different departments so that compliance requirements can increase. You can make ACs with lower emissions. So all this will increase cost for the company. Yes. Focusing on environment, ethical, social issues always increases costs. Okay. If you increase your governance, set up a good governance system, your cost increases because you need more person. If you focus on environment, less emissions, more reporting, your cost gets increased. Okay. If you focus on social issues, obviously that I need to make a park or I need to match wage rates, your cost will increase. So if you focus on ESG, your cost is definitely going to increase. Anyways, this question is now complete. First 5 marks, advantages of setting up a subsidiary in CTA. Second, NPV 20 marks, financial grounds whether we should accept, and the assumptions, and this 9 marks. Okay, so this question is over. You can copy, and that would be it for question number one. Once you copy, we will move towards question number two. Okay, I think we should now move towards the next question of this past paper. Okay, next question is the following exhibits available on the left-hand side of the screen provide information relevant to the question. It's something related to Halstock and Marnhall Company financial data. Okay. Okay, so Halstock Company is a listed company operating in the fitness club sector in the country of China. Halstock operates at the high price, high quality end of the sector. The facilities at its clubs include gyms, fitness classes, spas, and swimming pools. Halstock is strongly focused on customer satisfaction. A vital element in Halstock's company's approach to its customer is teamwork. It emphasizes customers working with instructors to develop individually tailored programs to help customers improve their fitness. Employees also work with other staff in teams to develop new services and upgrade existing services. Job satisfaction is high, staff turnover is low. A recession in Genia has meant that lower price fitness clubs have gained market share at the expense of high-end clubs. Despite this, Halstock has maintained a competitive position. Economic outlook in Genia is now better, and one consequence is an increased willingness of customers to pay for higher quality experience at fitness clubs. Halstock has previously grown organically but is now expanding by acquisition, rebranding clubs which it acquires as Halstock clubs. Okay, what is happening in these three paragraphs? Halstock is a listed company operating in fitness sector in the country of Genia. It operates at a high price, high quality end. Price is high, quality is high. Facilities are fitness classes, gyms, spas, swimming pools. Halstock is strongly focused on customer satisfaction. Okay. Emphasizing in teamwork, emphasizes customers working with instructors to develop individually tailored programs. Employees also work with other staff and teams to develop new services. Job satisfaction is high, staff turnover is low. Employees are also satisfied, customers are also satisfied. A recession in Genia has meant that lower price fitness clubs have gained market share at the expense of high-end clubs. Recession has come in Genia, so lower price fitness clubs. Halstock was high price. Lower price fitness clubs have gained market share. Despite this, Halstock has maintained its competitive position. Economic outlook is now better, and one consequence is an increased willingness of customers to pay for high quality experience at fitness clubs. Now the recession is over, customers again want to pay for a higher quality experience. Halstock has previously grew organically, but is now expanding by acquisition and acquiring clubs and rebranding them as Halstock clubs. This is Halstock. The other is Marnhall Company. Marnhall Company is a chain of lower price fitness clubs which was established by Olympic medal winning athlete Jared Marnhall, who is the CEO and owns 90% of its shares. Marnhall Company's clubs only offer gym facilities and fitness classes, no swimming pools, no spa like Halstock. Jared Marnhall has taken a close interest in all the clubs and has specified the facilities and approach to fitness classes at all the clubs. Staff at the clubs have little autonomy. The owner, Jared Marnhall, has given little autonomy. Customer satisfaction clubs has recently begun to fall due to limited facilities the club offers and lack of variety in the services provided. So Halstock was a high-end club. Marnhall is a lower price fitness club chain. Olympic award-winning athlete Jared Marnhall made it. He's the CEO, owns 90% of shares. It only offers gym and fitness classes. He maintains close interest, specified the facilities, autonomy is low. Customer satisfaction has recently fallen due to limited facilities. Okay. George Marnhall has said that Marnhall could be sold for an appropriate amount, although he is willing to be involved in the management of the combined company. Halstock boards will discuss bidding for Marnhall at its next meeting. So since company's satisfaction is falling, the owner has said that Marnhall can be sold at an appropriate amount, but he's willing to be involved in the management of the combined company. Now, Halstock board will discuss bidding for Marnhall at its next meeting. So Marnhall is being acquired by Halstock. Halstock's NEDs want to be sure that Halstock receives sufficient value from the acquisition. The NEDs are concerned about whether Halstock will be paying a fair price for Marnhall and whether the expected figures for combined company will be achieved. NEDs want to make sure that they receive sufficient value. NEDs want that they pay a fair price. Okay. Halstock's chair has queried whether the acquisition will achieve synergies. He believes that differences in organization culture, lower quality of staff at Marnhall, and their reliance on decision-making of Jared Marnhall will cause significantly difficulties in successfully integrating the two companies. Now, Halstock chair has raised one valid concern that there is difference in organization culture. We are high-end, they are low-end. lower quality staff at Manhall, and Judd Manhall's involvement may make it difficult in two companies being integrated. He also believes that the combined company may lose current Manhall customers who are price sensitive and do not wish to pay an increased membership fee. The chair had also said that combined company may lose current Manhall customers because Manhall's customers are low price paying customers. They may not pay higher fee like Halstock customers. So these customers may get loose after Halstock acquires Manhall. Okay. So this is the scenario number one. Okay. Next exhibit, financial data. The current market value of Halstock equity is 210 million. Who is Halstock? The high-end club. The market value of equity is 210. Halstock finance director has estimated the value of Manhall to be 145.8 million based on a free cash flow growth rate of 5%. So current market value of Halstock is 210. Halstock's finance director has estimated that Manhall, the company we're acquiring, is of 145.8 million. Free cash flow growth rate is 5%. If the acquisition of Marnhall goes ahead, the revenue of the combined company in year 1 to 4 is as follows. So revenue is given for the combined company, not for Halstock, not for Marnhall, but for the combined company, 230, 242, 255, 269. The revenue in year 1 is expected to be the sum of revenues in most recent year of Halstock and Marnhall, uplifted by 5%. How did they get the revenue in year 1? Sum of revenues of Halstock and Marnhall increased by 5%. Post-tax operating cash flows in each of years 1 to 4 are expected to be 22% of revenue. This is the operating profit. Okay. Operating cash flows, operating profit, 22% of revenue. Similar to the margins which Halstock has already achieved. So the revenues are given. Cash cost TAD is not given. Operating profit is given 22%. Combined company will require additional investment in non-current assets of 7.5 million at the end of year 1 and 0.45 for every $1 increase in revenue for 2 to 4. So additional investment in NCA 7.5 million at the end of year 1, 0.45 for every $1 increase in revenue. Revenue, post-tax operating cash flows, and additional investment in non-current assets in each year after year 4 are expected to be the same as year 4. After year 4 till perpetuity, they will be the same as year 4. Halstock's finance director has estimated that the acquisition of Marnhall will create revenue or cost synergies after tax with the present value of 18.6 million, in addition to expected increase in revenue. So finance director has planned that acquisition will increase synergies after tax with the present value of 18.6. Assume a post-acquisition cost of capital of 11%, target debt to equity ratio of 15:85. Cost of capital is 11%. WACC is given, and debt to equity ratio is 15:85. So since WACC is given, I think FCF to company can be applied, not FCF to equity, because otherwise we need KE. Judd Manhall has indicated that a cash offer of 160 million will be acceptable for Manhall company's equity. Halstock board believes Halstock shareholders will expect a gain of at least 15% of the current equity value of the shares from acquisition. The owner of Manhall, Judd Manhall, wants a cash offer of 160 million, but board believes that shareholders of Halstock expect a gain of 15% of current equity value. This is current equity value. They want a 15% gain. And they want to pay Manhall 145.8, but he wants 160. That's it. I will read it again. Requirements. Calculate the percentage gain in the value of Halstock shares with and without the expected revenue and cost synergies. Okay. So percentage gain in Halstock shares with and without expected revenue synergies. So with and without 18.6 million, the percentage gain in Halstock shares. Okay. Okay, now let's just revisit the scenario that Halstock was a fitness club sector, Genia country, high price, high end, staff turnover low, job satisfaction high, recession means that lower price fitness club gain market, but now it's recovery and customers want better service. Manhall, lower price fitness clubs, owner Judd Manhall, less facilities, and he wants to sell Manhall for appropriate amount. NEDs want to be sure that there's sufficient value, and Halstock chair has said that whether it will achieve revenue cost synergies. He believes organizational culture is different, and we may lose their customers who are low paying. Financial data is given that market value of Halstock is equity is 210, and finance director thinks that market value of Manhall is 145.8 million. Right. and growth rate is 5%, and revenue of combined companies given that post-tax operating cash flows, the operating profit is 22% of revenue, and combined company requires additional investment NC of 7.5 million, and you heard 0.45 for every $1 increase in revenue for 2 to 4. Revenue, post-tax operating cash flows, investment in NCA are expected to be same as in year 4 after year 4, so 5 to infinity is same. And finance director's estimated acquisition of Marnhall will create synergies of 18.6 in addition to expected increase in revenue. Cost of capital is given and debt to equity ratio 1585. Judd Marnhall wants 160 million, and Halstock Bulls believes that shareholders want a gain of 15%. Okay. Requirement A, calculate the percentage gain in Halstock shares with and without expected revenue and cost synergies. Okay. This synergy with and without. So firstly, the percentage gain in Halstock shares without synergies. Okay. And then with synergy will be just 18 million synergy. So percentage gain without synergy. Now, how to get the percentage gain in Halstock share? To get the percentage gain in Halstock share, current share price compared with combined company share price. You get percentage gain. Okay. Percentage gain in Halstock shares, so current share price, combined share price. Since here number of shares are not given, so we will take current share price or current value in total, divide and compare it with combined company share price or total combined company value. Because if number of shares are given, we take current share price and combined company share price. If number of shares are not given, we take in total current share price or current share price in total or current value in total, and combined company share price, combined company value. Now, what is the current share price of current value of Halstock? Because you're finding percentage gain in Halstock shares. Okay. So what is the current value of Halstock? Equity value 210 million. Let's find the combined company value. Now, how do you find combined company value? For a combined company, a revenue is given, operating cash flows is given 22%. This is the margin, operating profit margin, investment in non-current assets. So I think it's FCF and FCF2 company. So combined company value will be to FCF2 company, and FCF2 company, revenue, cash cost, and TAD. You get operating profit, interest, you get PBT, tax, PAT, add back TAD, less investment in NCA, less investment in working capital. FCF2 company. Discount factor, that is WACC. You get present value of all future FCF. That is basically value of company. Then you deduct value of debt. You get Value of equity. Remember, to find percentage gain in Halstock share, current share price of Halstock, combined company share price. When share price, number of shares is not given for individual share, you can take the total current share price or current value and combined company value. So current value is 210 million of Halstock. Percentage in Halstock shares, we need to get the current value of Halstock and combined company value. Okay, combined company value, FCF method. Let's start. It's 4-year data given. So let's start. Revenue 230, 242, 255. To 69. Cash cost TAD is not given. Operating profit is 22% of revenue. Interest doesn't come in FCF to company. You will get PBT. Same. Think tax is not given. You get PAT same. Add back TAD. So no TAD given. Less investment in NCA. So what about the investment in NCA? Investment in non-current asset, 7.5 million at the end of year 1. Okay. And then 0.45 for every $1 increase in revenue in 2 to 4. So 0.45 for every $1 increase in revenue. How much revenue has increased in year 1 to 2? 53.24, 50.6. This is the increase in revenue. 0.45 per $1 increase in revenue. Okay. Then 0.45 increase in revenue. How much revenue has increased? 56.1, 53.24. Then negative 0.45 increase in revenue. How much the revenue has increased? 59.18, 56.1. No investment in working capital. You get FCF to company. Now, how do you get FCF to company? Sum from PAT. B14 to B17. Okay, this is the FCF to company. Investment in working capital, investment in NCA student has highlighted. I just made a small mistake. It was 0.45 for every $1 increase in revenue. And what I did, I applied it on, I think, profit. So I just have to change it to revenue. Not 53.24 minus 50.6, it's profit. It should be revenue. So 242 minus 230. Then not the increase of profit, but revenue. 255 minus 242. And here 269 minus 255. Okay. So it was just a small issue which you guys needed to be aware that if percentage gain house stock share needs to be calculated without synergies. Now, without and with synergy is just 18.6 million difference, not a big deal. So if percentage gain without synergy, so it's current share price of Halstock or current value in total, combined company share price, combined value total. Current share price, current value in total is 210 million. Combined value through FCF to company as per the data. Revenue, cash cost, TAD, operating profit 22%. No interest comes PBT. There is no tax even, so PAT. Add back TAD, no. Investment in NCA. First year 7.5, then 0.45 for increase in revenue. So I took the increase in revenue 12.5, then increase in revenue 13.45. Working capital is not their FCF to company. Okay. Now, there's one more thing mentioned, which you all know in FCF. Revenue, post-tax operating cash flows, and additional NCA in each year after year 4 are expected to be same as year 4. So after year 4, 5, 2, infinity. After year 4 is 5, 2, infinity. All these things are remaining same as year 4. Okay. 269, 59.180, 59.180, 59.180, negative 6.3, 52.88. You see, it's clearly mentioned in the question. Revenue, operating cash flows, investment in NCA in each year after year 4. After year 4 means 5 to perpetuity, same as year 4. Okay. So you get FCF, discount factor WACC. Okay. So year 1, 2, 3, 4 we will take from here. 0.901, 0.812, 901, 731, 901, 812, 731, 659. 5 to infinity, take last year factor. WACC minus G. G is last year's discount factor 0.659 over WACC minus G. G is 0. No, sir, it was 5% wrong. The finance director has estimated the value of Marnhall to be 145 based on free cash flow growth rate of 5%. This was Marnhall's growth rate, not the combined company. Okay. When it says revenue, post-tax operation cash flows, additional investment in NCA in each year after year 4 will be same as year 4. When after year 4 they are same as year 4, there is no growth rate. If it said it is increasing by 4%, I would have taken growth rate 4%. But if it's same as year 4, growth rate is 0. Okay. Present value. So B18, steric B19. Drag it. So this is the present and the future FCF. Then total present value of all future FCF. This is the value of company, total present value of all future FCF. Okay. Less value of debt. So for the combined company, the debt to equity ratio is 15:85, 15% debt, 85% equity. So value of debt is 15%. So minus 15%, 466.06 will give you value of equity. Okay. So this is the combined company value. Okay. And I want you to copy this, then I will further continue. Okay, now pay attention as I'm going to solve the requirement now. That it asks for percentage gain in value of Halstock shares. So to get percentage gain in Halstock share with and without synergy, synergy is just 18.6 million. So I'm just calculating the percentage gain in Halstock share without synergy. So ignore this 18.6 million synergy. Okay. And percentage gain in Halstock shares. So current share price of Halstock or current value 210. Combined company share price, combined value, you get the percentage gain. Okay. So combined value is via FCF, revenue, operating profit, interest, tax, PAT, investment and CA. Very small items were given. Investment, working capital, FCF to company. Discount factor back, you get present value. Present value of all future FCF is the value of company less value of debt, you get value of equity. Now, this is the combined company value. Okay. Now, how much will the Halstock gain? Okay. Will Halstock shares gain 210 million and 396 difference? The answer is no. Why? Because look at this working here. The combined company value please pay attention to this. Is 396.15. The combined company value is 396.15, right? But Halstock existing value was 210. And Marnhall existing value is 145.8. So the benefit or additional value created, or you can say additional benefit, is basically $40.35 million. Okay. So usually the percentage gain for Halstock shareholder should be like this, that the overall gain is 40.35 and their existing value was 210. So percentage gain should be 40 million out of 210 million, 19.21%. But I just want to make one small change in this wording, that for percentage in a file stock, their value was 210. And the combined company they get is 396.5 less their value, less manual value. So they only got benefit of 40 divided by 210 percentage gain. But I just want to correct one thing here. This is the benefit, okay, or additional value created, but you need to deduct one more thing from this, that you are not going to get Marnhall for 145, right? Because if you be prudent, as per your finance director, the value of Marnhall is 145.8 million. But the good Marnhall has indicated that he will take it for 160 million. That means you won't get it for 145.8 million. You will get it for 160 million. So the difference is basically the premium you need to pay to get this company. So if you be prudent, the additional value created will be 40.35, which you have just got here. But you have to pay approximately 14.2 million more because 145 was the value. But he's saying that he will give in 160. So you have to pay a premium. $14.2 million. So the additional value or additional benefit to Halstock will be 40.35 less 14.2. And now you can say that percentage gain is the benefit they are getting. Is 26.15 million, and their existing value was 210 million. So if you get the percentage gain for Halstock, the percentage gain would be 26.15 divided by 210, 12.45%. Okay. Many people say that we got stuck in this portion. No worries, this is just 1.5 mark because the main marks are for FCF to company. And you must understand that FCF to company has to be done and how it is done. And everybody would have done this in the question. So for percentage gain in Halstock share without synergies, a no Halstock value is this. And I found combined company value 396.15 billion. I cannot say percentage gain is just the difference because this value is of combined company. Already Halstock value and Marnhall value was given, so we deducted. So the benefit for Halstock shareholder is 40.35, but they won't get this complete benefit. They have to pay 14.2 premium because Judd Marnhall is saying I will pay it for 160 million. I will give the company for 160, not 145.8. So you have to pay premium. The net benefit they will get is 26.15, and if you get percentage gain, so 26.15 divided by 210 is 12.45%. Okay, please note it. Then I will do percentage gain with synergies. It's just a 1 minute thing because the synergy is 18.16 million. Okay, now we have to find the percentage gain in Halstock shares with synergy of 18.6 million. It's very easy. Percentage gain in Halstock share with synergy. Now, what is the synergy? Present value of 18.6 million. This is synergy. So just add this in present value. 18.6 million is the synergy. So if it's with synergy, the acquisition will create synergy of present value 18.6. Just add it in present value. You will get the benefit with synergy. So where is the present value here? This is the present value. So just add here 18.6 million. Why am I adding here? Because it's present value of synergy. So I have to add it wherever is the present value. So I add 18.6 million here. Obviously, the value of company will increase through this. Now it's okay. Now this is the value of equity. Obviously, it has increased. Previously, it was 396, I think. Now it has increased because now you are calculating the benefit with synergy. So I added the synergy. Okay. Now the combined company value is 411.96 after synergy. Existing value was 210,145.8. Additional value will be 56.16. But this is not the benefit Halstock shareholders will get. They have to pay a premium of 14.2 because 145.8 is the current value. But John Marnhall wants 160 million. So 14.2 premium. Now our additional benefit would be 41.96 million for Halstock. Previously, it was 26.15. Now, after synergy benefit, it's 41.96. So now the percentage will be benefit 41.96 and existing value 210. So the percentage gain will be 41.96 divided by 210 existing value will be approximately 20%. Right? So percentage gain with and without synergies is there. Firstly, I needed combined value. So I got the combined value, present value of all future FCF. Okay. That was without synergy. I didn't consider 18.6 million. So I said combined value is 396 less the existing values. Additional value created was, I think, 396 less 210 less 145.8, approximately 40. But 14.2 premium had to be paid. So Halstock would only get benefit of 21 million. Okay. 20 million, sorry. So 20 divided by 210, it was 12%, right? But with synergy benefit, it will increase by 18 million, whatever is the synergy. So I added in present value 18.6. My value changed. Value became 411.96. Same thing as existing value of Halstock Marnhall. Value was 56.16. Now premium has to be paid. So the previously benefit, which was approximately 26 million, now it rose to 41.96 million, and percentage is 26 over 2, no, 41 over 210. Okay. Hope this is clear to you. Our 9-mark requirement is over. You can copy this, and then the further 2 parts will result in the end of question number 2. Okay. Okay, let's move towards the next requirement now. Discuss the concerns which may be raised by the NEDs about the calculation in Part A. It's a very general requirement that you can discuss the concerns which NEDs can raise about calculations in Part A. Now, what are the calculations in Part A? These are all the calculations in Part A. Okay. The revenue, the cash cost TD, operating profit, interest, PBT, tax, NCA, FCF to company, discount factor, present value of all future FCF, less value of debt, value of equity, and then the additional benefit created. So the requirement is what concerns NEDs can read about calculations in Part A. General discussion. Now, NEDs can raise concerns on revenue increase. What is the basis for this revenue increase? Okay, of the combined company, provided that the question clearly mentioned that Marnhall is still experiencing falling customer satisfaction. So how this revenue increase is projected, non-executive directors can raise concern on that. NEDs can raise concern on a revenue increase. Every year, as it was mentioned in the question, that Marnhall is experiencing fall in customers. NEDs can also raise concern on operating profit margin as 22%. They can doubt whether it can be maintained for all years. Okay. What else they can raise concern on? They can raise concern on discount factor, 11%, which can change with changing economic conditions, but it has been assumed constant. There's one thing in the question that assume post-acquisition cost of couple 11% debt to equity ratio of 15:85. The debt to equity ratio is assumed as 15:85. NEDs can raise concern on this because if this target debt to equity ratio is not achieved, it can affect equity value, which in turn will affect the percentage gain on Halstock shares. Calculated. Okay. What else have you calculated? You took synergy impact on this. Okay. So NEDs can also raise concern on cost and revenue synergies of 18.5 million, 18.6 million. They may ask the basis on which it was calculated. So overall, a very generalized requirement that discuss the concerns which may be raised by needies on Part A calculation. So we have raised all their concerns. If you have other points, most welcome. Anyways, this is over. You can copy this and then we will do the third part. Okay. Okay, let's move towards the last requirement now. Recommend actions which may overcome the barriers to synergy identified by Halstock's chair. 6 marks. Recommend actions which may overcome the barriers to synergy identified by Halstock's chair. Now let's just read what did Halstock's chair identify. See, last para. Halstock's chair has queried whether the acquisition will achieve synergies. Now, Halstock's chair thinks synergies won't be achieved. He believes differences in organization culture, lower quality of staff at Manhall, and reliance in decision-making of Judd Manhall will cause significant difficulties in successfully integrating the two companies. He also believes combined company may lose current Manhall customers who are price sensitive and do not wish to pay increased membership fees. Now, the requirement is recommend actions which may overcome barriers to synergy identified by Halstock Share. You need to recommend actions which may overcome the barriers to synergy identified by Halstock Shares. Now, what did Halstock Share identify? Halstock Share said that synergies won't be achieved. He's saying there are some barriers to synergy. Understanding? Barriers to synergies. There's something stopping synergy. What? He thinks that differences in organization culture, lower quality of staff at Manhall, reliance on shared Manhall decision-making will cause difficulties in integration. He believes combined company may lose current Manhall customers who are price sensitive, do not wish to pay increased fees. So he says that due to differences in culture, lower staff of Manhall, reliance on shared Manhall, may be difficult in integration, so synergies won't be achieved. And he thinks that customers of Manhall we will lose because they're price sensitive, they do not wish to pay increased fee. He thinks there are some barriers to entry. synergy. You need to recommend actions which may overcome this. Now, according to Halstock chair, synergies won't be achieved. This is also called barriers to synergy due to many factors. Firstly, he thinks that we may lose Marnhall customers who are price sensitive. He thinks synergy can't be achieved because we will lose Marnhall customers who are price sensitive. You can write anything. This first, it's my choice. He thinks that we will lose Marnhall customers who are price sensitive if they do not wish to pay increase fee. So he thinks that due to these factors, synergy won't be achieved. You need to recommend actions to overcome these. To overcome such problem, Halstock can offer incentives for old Marnhall customer. Maybe we can allow them to use upgraded facilities for a while at same low price so that they feel the difference they are getting, and this may encourage them to believe that it's value for money and they may pay higher price. Okay, we can tell them, okay, enjoy the facilities at same old rates, don't go away. Once they enjoy, feel the facilities, better facilities, they may pay higher rates. Okay. Now, he was also of the view that synergy can't be achieved because reliance on Judd Manhall decision making will cause significant difficulties in integrating the two companies. Another issue the chair highlighted was reliance on decision making Judd Manhall. How to overcome this? This can be overcome by restricting Judd Manhall roles in day-to-day operations. You can involve him in management in more senior decision-making tasks, but day-to-day operations, his role can be minimized. So obviously, this problem can be overcome if you don't involve him in day-to-day affairs. What else the chair said? Differences in organization culture, lower quality of staff. This is also a problem with the chair. As per the chair, differences in organization culture may also make it difficult in achieving synergies. This can, because you need to recommend actions which may overcome these problems. By giving training to Marnhall's staff regarding the organization culture. They can also be posted at Halstock centers so that they see and themselves get trained on new organization culture. Another issue highlighted by chair was low quality staff. This can be again overcome by staff training or by hiring or recruiting good quality staff. Staff can also be improved by giving motivation via incentives. As in Halstock, it was mentioned that job satisfaction is high, turnover is low. So they keep their staff motivated. They can also keep motivation among these employees, the Marnhall's employees as well. So the chair highlighted some issues because this part was only related to recommend actions which may overcome barriers to synergy identified by chair. So chair identified that there are barriers to synergy because of low quality staff, child manual decision making. We can lose price sensitive customers. So I recommended some actions. I wrote all the issues identified by the chair and then recommended actions. Okay, you can note this. This question number 2 is now over. And now after you copy, we will move towards the third question. Okay. Okay, so let's start question number 3 of this September-December 2025 attempt question. Okay. So again, the information is that following exhibits available on the left-hand side of the screen provide information relevant to the question, Passmore Company hedging a transaction. Okay. Information should be used to answer the question requirements within your chosen response option. So let's see the case study here. Passmore is a company based in USA. So the company is based in USA. It supplies semiconductors mainly to its home country, but has recently started to expand internationally with a particular focus on Asia. Based in USA, home currency dollar supplies semiconductors mainly to its home country, but has recently started to expand internationally with a particular focus on Asia. Passmore has made a number of significant sales in India, and it boasts plans ultimately to set up subsidiaries there and other Asian countries. Passmore's board is currently considering the infrastructure which the company will need in the longer term if it expands in Asia, and at present, all treasury activities are carried out by the finance department. So all treasury activities are being carried out by the finance department, but the finance director suggested establishing a separate treasury department. Before agreeing to this proposal, Passmore's CEO wants to be sure that the treasury department will make positive financial contribution by maximizing account saving costs. So it's a basic case study here that Passmore is a company based in USA. It supplies semiconductors mainly to its home country. It has recently started to expand internationally, particular focuses on Asia. Passmore has made a number of significant sales in India. Board plans ultimately to set up subsidiaries. Board is currently considering infrastructure. At present, all treasury activities are carried out to the finance department. Finance director wants to establish a separate treasury department, but before agreeing to this proposal, Passmore CO wants to be sure that the treasury department will make positive contribution. Next exhibit. It is 1st February. Passmore has just agreed a major sale in India where the customer will pay 202 million rupees for the order on 31st August. So today is 1st February. Customer will pay 202 million rupees on 31st August. That means we are expecting a receipt of 202 million. Customer will pay 202 million. We were expecting a receipt of 202 million for the order on 31st August, right? So if today is 1st Feb and you are receiving on 31st August, that means whole February, then whole March, whole April, whole May, whole June, whole July, whole August. Okay. So you're receiving after 7 months. You're receiving after 7 months, right? So it is 1st Feb and we are receiving 202 million on 31st August after 7 months. Passmore's finance director is considering using forward contracts, futures, or options. Okay, so it's a perfect case study of hedging that finance director is considering forwards, futures, options to hedge the receipt. Needs calculations comparing these instruments. Exchange rate is rupee per dollar. So you are in USA. Dollar is coming in denominator, so it's an indirect quote, right? Spot rate is given to, and 7 months forward rate is given. Futures, contract size is in rupees and price is quoted at R per dollar one. Okay. So you are expecting 202 million rupees and the contract size is also in rupees. Okay. And quote is indirect. So March, June, September futures given. That means this is 1st February. You are given future of 31st March. So whole Feb, whole March, 2 months. Then till June, Feb, March, April, May, June, 5 months. And Feb, March, April, May, June, July, August, September, 8 months. 2 months, 5 months, 8 months, future is given. In options, contract size is rupee 5 million, excess price premium is cents. In premium is in cents, right? So this is the exercise price is dollar coming in denominator, indirect quote, but the premium is in cents. Okay. Calls and puts are given, and extra price, just one exercise price is given, March, June, September, March, June, September. And the formality statement assume futures and options contract matured at the month end basis can be assumed to diminish to zero at contract maturity based on month interval. It can be assumed there is no basis risk. Calculation should assume that options are exercised. Okay. Recommend an appropriate hedging strategy. So you need to recommend an appropriate hedging strategy for the R202 million, which Passmore is due to receive, discussing the factors that will determine the decisions. You should show all relevant calculation to support the advice given. 4 marks discussion and remaining marks for calculation. So appropriate hedging strategy, and the hedging strategy is either futures, either options, or either forward exchange contract. Okay. And advice on ways in which Treasury Department can make a positive contribution, 8 marks. So this is a good theoretical requirement that how Treasury Department can make positive financial contribution, and then professional marks. Okay, so let's start. First, to just make the small information which will be relevant. Right, so the important thing that the company was based in USA. ठीक है. Okay, ठीक है, I will get back to you on this. Okay. I'm sorry. Okay, so Passmore is based in USA. Theoretical term. Then we are saying that it is 1st February. Rupee 202 million in on 31st August. So today's 1st Feb, 1st March, 1st April, 1st May, 1st June, 1st July, 1st August, and then 31st August. Okay, so 7 months. Okay, so today's first rep, and the company will receive 202 million in 7 months, right? And it's considering using forwards, futures, or options. Exchange rates are given. Dollar is in denominator, indirect quotes, spot rate, 7 months forward is given in futures. You're given March futures. So today's first rep, you're given March future, 1st March, 31st March, 2 months. This is 2 month future. Today's first rep, you're given for 30th June, 1st March, 1st April, 1st May, 1st June, 30th June, 5 months, right? Today's first rep, so 1st March, 1st April, 1st May, 1st June, 30th June. And you're given for September. So 1st March, 1st April, 1st May, 1st June, 1st July, 1st August, 1st September, and 30th September. So 2 months, 5 months, 8 months. Option data is given, and you need to recommend an appropriate hedging strategy. Okay. So let's start on this. First is the forward exchange contract. I will first calculate and then recommend an appropriate hedging strategy. So receipt is R202 million. It's an indirect quote, so we will divide it the 7 month rate because we're receiving in 7 month. So 7 month rate is given. It's an indirect quote, so division. Low risk buying and high risk selling. So obviously it's a receipt we will sell 70.8500. So this equals, okay, 2.8511. This is the forward exchange contract, right? The second technique which we want to attempt here, so we have to attempt here, sorry, futures. For futures, I've always told you there are 3 steps. Step number A, find lock-in rate. So how you will find the lock-in rate? It's quite simple. Finding lock-in rate that you are given. Today's 1st Feb, you are given future of 30th March, 2 months. 30th June, so 1st March, 1st April, 1st May, 1st June, 30th June, 5 months. And 30th September, 1st March, 1st April, 1st May, 1st June, 1st July, 1st August, 1st September, and 30th September. 2 months, 5 months, 8 months. And your payment or receipt is after 7 months. So you'll take 5 month future and 8 month future to get a lock-in rate. Okay. Five-month future, 8 month future. 70.6874. 70.9550. So it's a rising trend. in 3 months. So you will go for per month. Per month will be this C14. And then finally, 7-month lock-in rate. So you're standing at 5 months, add for 2 months, or you're standing at 8 months, deduct for 1 month. Both will produce the same answer. So it will be C12, 5 month, add the 2 month rate, rising by C15 per month into 2 months. You've got the 7-month lock-in rate. Then B, expected receipts or payments. Here it's receipts using lock-in rate. So it's 202 million. Indirect quote here as well. Dollar is in denominator. Okay. And finally, the third thing here, number of contracts. So previously, number of contracts were like this, that contract size was in, for example, dollars. For example, it's in dollars. So what you needed to do is that you needed to take this figure 2.8505 because it's converted into dollars now from rupees and divide by the contract size. Here, the receipt is 202. Okay. And the contract size is also in rupee. So number of contracts will simply be 202 divided by 5, 40.4 or 40 contracts. Okay, so this is, you are done with futures. The answer of futures is this. And the answer of forward exchange contract is this. Not too much difference. One is 2.851049 $2.851 million and $2.8505 million. Okay, so future steps are done. Lock-in rate for 7 months, then receipts using lock-in rate. Number of contracts were previously faced in dollar. This dollar divided by the contract size. However, if it's given in rupee, direct rupee over rupee. You can copy this, and I will move towards options. Now, the last technique is options. And you know that in case of receipts, the formula in options is expected receipts plus unhedged amount minus premium payable. Okay, so we will first find the expected receipts using exercise price. This is what we do. That first we find expected receipts using exercise price. Then unhedged amount premium payable. Now, since now I've told you that the formula for expected receipts was number of contracts into contract size. So for number of contracts, what was taught to you in the formula sheet was expected receipts in foreign currency divided by exercise price upon contract size. Remember? Or number of contracts you choose is the expected receipts in foreign currency 202 million, divide by excess price so that it gets converted into dollars, and then divide by the contract size, which was usually in dollars. Here, number of contracts won't be like this. Number of contracts here will be very easy because you see the tone of this formula is expected receipts in foreign currency, that is 202 million. If you divide it by the exercise price of this, it's an indirect quote, right? It becomes dollar. It becomes dollars. And then if you expected receipts in foreign currency was 202 divided by excess price 70.8 becomes in dollar, then it cannot be divided by the contract size because it should be in dollars. Whereas in this question, contract size is in our 5 million. So number of contracts would be very easy here, like we did in the above part as well. That for number of contracts, it would be a very simple thing that expected receipts in foreign currency is 202 million and the contract size, it's R 202 million. And contract size is also R 5 million. So directly divide them. You get 40.4 and round it down. 40 contracts. This type of question has also been done in the classes as well, that it's expected receipts in foreign currency, which is 202, divided by the exercise price 70.8 to get dollars. It becomes dollars, right, when you divide it. And then you divide it by the contract size, that should be in dollars. So you get number of contracts. But here, expected receipts in foreign currency is also ours 202 million. And the contracts is also R 5 million. So direct 40 contracts. Okay. So let's find expected receipts. It's number of contracts into contract size. So number of contracts is 40 contracts. Into contract size is 5 million. R. So this makes it R 202 million. Sorry, R 200 million. Okay. Number of contracts 40 into contracts is R 5 million. So this makes R 200 million, but we need this in dollars. So now it's R 200 million divided by the excess price. That is 70.8. You will get dollars. So R 200 divided by 70.8. 2.8248 million. Okay. I will repeat it again. First in options, you need expected receipts. Expected receipts is basically number of contracts into contract size. For number of contracts, I have taught you this. Expected receipts in foreign currency 202 divide by excess price so that it gets converted from R to dollars, and then divide by contract size, which is in dollars. Apply this if contract size is in dollars. But if contract size is R 5 million and expected receipts are 202 million, directly divided to get number of contracts 40. Now, number of contracts is 40. Number of contracts is 40 and contract sizes are 5 million. Number of contracts is 40 and contract sizes are 5 million. So 40 into R 5 million is R 200 million, but you need expected receipts in dollars, right? Because the final answer has to be in dollars. So 200 million R divided by the excess price, you get $2.8248 million. Okay. Unhedged amount. How do you get unhedged amount? This was expected receipts in foreign currency, 202 million R minus number of contracts 40 into contract size R 5 million into excess price. No need to do into excess price because 40 contracts into 5 million R makes it 200 million R. If you multiply it by the excess price, it will again get converted into dollars and that would become problematic. Okay. So simply R 202 million was the expected receipts minus number of contracts 40 into contract size R. No need to convert into excess price. When do we do this? When this is in a currency and 40 contracts into contract size was in dollar. For example, 40 contract into contract size was in dollars. You then need to multiply it to get the same currency. Okay. But here it's 202 million R minus number of contracts into contract size is also R 5 million. So no need to multiply it by the excess price. The unhedged amount is R 2 million. And what do we do with this? This unhedged will be hedged using forward exchange contract. So for just a forward rate, 70.85. Selling forward rate. Point 0.0282. Okay. Had the contract size been in dollars, it would have been straight like that. That expected receipts $202 million divided by excess price. It becomes dollar divided by contract size in dollars. You get number of contracts, everything straightforward. Then unhedged R202 minus number of contracts 40 into contract size would be in dollars and multiply by the excess price. That would have been same. Why we are stopping here? Because number of contracts would be very easy here that R202 divided by R5. It's 40 contracts. Contract size R5 million becomes R200 million. Cannot leave it in R. We need in dollars, so convert it to dollars by dividing. Okay. Similarly, unhedged R202 minus number of contracts into contract size 14 to 5 makes it R 2 million. Unhedged, hedged using forward exchange contract, premium payable. How do you get premium here? Remember the formula of premium. For premium, it was number of contracts into contract size into premium amount. So what is the premium amount? Remember, it's a receipt case. We are receiving 202, so we'll try to go to the money changer and try to sell R. Okay. So he's offering contract in R rupee. So we are receiving 202 million rupee and we will go into money changer to sell rupee. He's offering contract in rupee. We'll simply sell rupee. That means we'll take put option. And we are receiving on 31st August. So we'll take the nearest September put option. You know the general rule: in receipt, put option; in payment, call option. If the contract size is in same currency. However, if the contract size would have been in dollars, then I would have said I would be receiving 202 million rupee and go to the money changer, try to sell rupee. Okay. But he's offering contract in dollars. So he's not offering in rupee. I'm selling rupee, right? But he's offering contract in dollars. So selling rupee means I'm taking dollars. So I will be taking dollars, and he's offering in dollars. I will take a call option in receipt case. Had the contract size been in different currency, but since the contract size is in R, I go and sell. I want to go and sell R. Contract size is also in R. I will sell put option. However, if the contract size is in other currency, make sure we remember the class topics that it needs to be a call option if it's in dollar, because selling rupee means taking dollar. If it's offering in dollars, take dollars, call option. If it's a receipt offering in rupee, I'm selling rupee, put option. So it's 2.42 cents. So in dollars, it will be 2.42 divided by 100. 0.0242. Number of contracts into contract size into premium 0.0242. $4.84 million. Okay, one thing which I just realized that in all the previous question, the premium is cents per hour. Only it's written cents per hour. Cents per hour. Okay. So usually if it's cents per hour, we say, okay, it's in cents, 2.42. And we divide it by 100 to convert it into dollars and use that figure. But here for the first time, it's given cents per hour 100. See here, it's cents per hour 100. So it's 2.42 is cents per hour 100. So now what we have to do is 2.42 is not cents per hour. So we just need to divide it by 100 and get it. No, it's cents per hour 100. So first divide by 100 to make it cents per hour. Okay. This is cents per hour now, 0.0242, and then to convert it into dollars, 0.0242 needs to be again divided by 100, and you will get 0.0242 divided by 100 as 0.000242. Okay, so this makes it 0.000242 into 5 into 40, 0.0484. And now I've got all the three things. I will just work them around to get my final answer. That expected receipts are 2.8248 million plus unhedged is 0.0282 million minus premium is 0.0484 million, and I get the final answer as 2.8248 plus 0.0282 minus 0.0484, 2.8046 million. Options can be a bit tricky for some people. You might say, okay, this is a bit complicated, specifically the options case. Why? Because the contract size was in R. So when the contract size was in R, the first major problem is number of contracts into contract size 40 into R. 5 million, it's 200 million in R. You have to convert it into dollars. Okay, previously what you used to do is that expected receipts in foreign currency was 202. You used to divide it by the exercise price to get dollars, and the contract size was also in dollars. Here you have to be alert that if it's 40 contracts and R 5 million, it's 200 million R, and you divide it to get dollars. Previously, if expected receipts in foreign currency is 202, we directly divided it by exercise price to get dollars and divide by the contract size in dollars to get number of contracts. Your expected receipts was 202 million R. Contract size was also in R. You directly divide it. Okay, 40 contracts into contract size is 200 million R. You have to convert it into dollars because final answer has to be in dollars. Unhedged is number of contracts into contract size and the expected receipts deduction. So expected receipts is R202 less number of contracts into contract size. You got 200 million R. No need to multiply it with the excess price because that will make it dollars. So R2 million is the unhedged and you need to convert it via, what do you say? Forward exchange contract 0.0282. And premium is number of contracts into contract size into exercise price. Exercise price was again a bit complicated, can make error that number of contracts is 40, contracts is R. You need to multiply it by the premium. Premium is 2.42 cents. So you need to divide it by 100 to get $0.0242. But it was not cents per hour. It was cents per R 100. So first need to divide it by 100 to get cents per hour and then convert it into dollars. Okay. Since this final answer is in dollars, no need to multiply or divide it by the spot rate. Why? This is done in the previous few questions, that when the premium comes as the answer, we usually multiply or divide it to get into the foreign currency. But here, since the contract size was in R, and you multiply it with the exercise price in R, you directly get dollars. So no need to further multiply or divide it because you have already got the answer in dollars. Number of contracts into contract size into exercise price. Exercise price was in dollars. So once you multiply it with the exercise price, cents or dollar, make sure it's not cents per hour, it's cents per hour 100. You get the dollar answer and the final answer. So all the three techniques answers are here. Your answers of I think forwards was 2.85011094. 2.851. Okay, so this is the summary. Answers for forwards, futures, and options. And you can see that the highest receipt is being given by forwards. We'll opt for that, but we will write it in discussion. So first you can copy options and then I will start the discussion. Okay, so recommend an appropriate hedging strategy for 202 million, which passers due to receive, discussing the factors that will determine decision. You should show all relevant calculations. 4 marks are available for discussion. Okay, so just 4 marks for discussion. Let's start it. Since it is a receipt case, you know the pattern. The company will look for a hedging method that gives highest option or highest amount. Looking at the figures calculated, forward exchange contract is giving $2.85 million. Futures contract is giving $2.8505 million. An option contract is giving $2.8046 million. Although options do carry the flexibility that company can exercise it or let it lapse. It usually proves costly due to high premiums involved. So, company must select either forward or future. Although difference between both of them is nominal. Company will opt for it is recommended to see pros and cons of both methods before taking any decision. In current circumstances, forward exchange contract seems to be the best choice. Best choice as it is giving highest amount, but it must be exercised at any cost. Because once you enter into forward exchange contract, you have to bear that. Okay. So you have given the recommendation, you can copy, and then we'll move to the next part. Okay, let's move towards the next part now. Advise on ways in which Treasury Department can make a positive financial contribution to Passmore. So we need to advise on few ways in which Treasury Department can make a positive financial contribution. Now you all know what is the function of Treasury Department. Treasury Department basically manages everything related to cash, borrowing, deposit, banking, risk management, forex currency management, investment decisions. Okay. So having a treasury department can make a positive financial contribution. How it can make, let's just write few points. See, it has expertise. It handles all foreign currency transactions of a company rather than separate dealing every foreign currency transaction. A treasury department manages all forex transactions. This leads to better risk management. Okay, this can be one point. Now, see, the company is based in USA. It is expanding internationally. Okay, wants to set up subsidiaries, and at present, all treasury activities are carried by finance department. So every subsidiary will have its own finance department, which will be handling cash, but finance director wants a separate treasury department. So if the company has one treasury department rather than separate finance departments, you have studied this in the classes as well. All borrowing and deposit transactions will be done by that centralized treasury department. So this will give us better deposit rates and lower borrowing costs. So we can write this as well. Okay, a treasury department has access to whole pool of cash. Obviously, now no separate finance departments, one treasury department. So it will help in making better investment decisions for the company. Treasury department can also effectively manage taxation, netting of different transactions between subsidiaries so that taxation is minimized. No specialization of Treasury Department. They have access to expert staff so they can manage all risk management, banking, borrowing, deposit, better investment decisions, manage taxation. Our Treasury Department can also manage lending slash borrowing rather than different subsidiaries going to borrow from bank. A treasury department can arrange lending between subsidiaries, leading to lower interest cost for the company. Okay, when you have all separate finance departments, every subsidiary needs finance, they need to go to the bank. Treasury department knows, a central treasury department knows that how much cash is there in the company and they have access to all cash. So rather than going to external parties for borrowing, they can arrange lending between the subsidiaries, lowering interest costs for the company. So better risk management, better taxation, better investment decisions, better borrowing deposit rates, lending between subsidiaries. These are the ways in which a treasury department can make a positive financial contribution. Okay, you can copy this and over this question, and the past paper is over now. Okay.